Good morning. Thank you for joining today's webinar. We're going to talk about how to isolate your non-deductible IRA funds by using a solo 401k plan. This is a method that a lot of taxpayers are not aware of. We're going to cover that topic today. We're also going to answer your questions live on the stream here. As always, today's presentation is for informational purposes. We are not providing investment advice or tax advice on today's webinar. Don't forget to follow the conversation on our community. Let me share that community page with you. So here's our community page. The address is mysolo401k.net/my community. We have lots of forum posts out there and a large video library. Take a look at our artificial intelligence page as well, where you can ask questions surrounding not only solo 401k plans, but also the rollover business startup 401k and the self-directed IRA LLC. Feel free to shoot your questions over here on the live chat as we go over this topic here today. So a little background first regarding non-deductible IRAs. So a non-deductible contribution to an IRA, it's just as it sounds. You don't get to claim any income tax deduction when you make a non-deductible IRA contribution. Hence why it's called a non-deductible IRA contribution, as it does not reduce your taxable income for the year when you make that contribution as such. So the reason taxpayers make non-deductible IRA contributions in lieu of deductible contributions is because their adjusted income is too high. Or maybe they participate in a daytime employer 401k or even a solo 401k for that matter, which precludes them from making non-deductible IRA contributions if their income is too high. The IRA owner participant is going to track those non-deductible IRA contributions each year by filing Form 8606. They file that with their Form 1040 tax return. So that can be a little bit of a headache having to do that every year. As a result, that's where the pre-tax solo 401k comes into play. Because with a pre-tax solo 401k plan, you're going to be able to isolate those IRA contributions, those non-deductible IRA contributions. And we're going to talk more about that in a moment as to how you can use the solo 401k. Now, keep in mind that just like a Roth IRA cannot be transferred to a solo 401k plan, the same is true for non-deductible IRA basis. So if you have a non-deductible IRA, the basis cannot be transferred to the solo 401k. So those same restrictions that apply to a Roth IRA will apply to the basis. However, it does not apply to the gains on the gains on that non-deductible IRA. So when you convert that basis to the Roth IRA, so that non-deductible IRA basis, when that gets converted to the Roth IRA, that's not going to be taxable because you never took a tax deduction when you made that non-deductible IRA contribution. However, if you were to convert the gains of that non-deductible IRA to that Roth IRA, those gains would be taxable. Well, again, by using a solo 401k plan to isolate those basis or those contributions on a non-deductible IRA, you're going to be able to transfer the gains in that non-deductible IRA to the solo 401k plan, thus leaving the basis, which would then get converted to the Roth IRA. So that's what we refer to regarding how to open a solo 401k and then facilitate the backdoor Roth IRA conversion. So we're talking about backdoor Roth IRA conversions, where you make a non-deductible IRA contribution and then you convert it to the Roth IRA. You generally want to convert it right away so there are no gains, but there are instances where you may have commingled non-deductible IRA contributions with annual traditional IRA contributions, and that's where you need to understand how to open a solo 401k plan. So we're going to talk about those eligibility requirements, and B, how to facilitate the backdoor Roth IRA conversion of just those non-deductible IRA funds. So for example, let's say John is self-employed and he opens a solo 401k plan for his self-employed business. He finds out that he has an IRA that's a traditional IRA that contains a total of $20,000. So the value is $20,000. Of that $20,000, $5,000 of that is made up of non-deductible IRA contributions. So he made a $5,000 non-deductible IRA contribution in some prior year, which means he never took a deduction for that $5,000 contribution. He's been filing Form 8606 every year to keep track of the non-deductible IRA contribution basis. So now John decides that he wants to transfer the $15,000, which is the gains of that $20,000, to a solo 401k plan so that he can isolate that $5,000 basis. So he's going to be able to transfer that $15,000 to the solo 401k as a non-taxable direct rollover. So he would complete the IRA transfer form, and then those funds would get moved over to the pre-tax solo 401k, therefore leaving just the basis in that non-deductible IRA of $5,000. So he's then going to be able to convert that $5,000 to the Roth IRA. He wouldn't be able. He's not going to be able to transfer that basis, that $5,000, to the pre-tax solo 401k, nor can it be converted to the Roth solo 401k. But again, he can transfer the gains, that $15,000, because those are pre-tax funds. Those can be transferred to the pre-tax solo 401k, and then the $5,000 in basis, he'll convert that to a Roth IRA. So he may have a Roth IRA already. He can use that Roth IRA, or he can open a new Roth IRA and convert that $5,000 basis to that Roth IRA. So that's how you isolate non-deductible IRA funds, by using a solo 401k plan, so that then you can do the backdoor Roth IRA conversion without having to touch those earnings. And the purpose, of course, of doing non-deductible IRA contributions is to indirectly get more Roth IRA money in your Roth IRA. Okay, let's take a look at some questions here, and then we're going to talk about the solo 401k eligibility requirements, because, of course, you're not going to be able to isolate non-deductible IRA funds using a solo 401k plan unless you're eligible. So we got to make sure you're eligible to open a solo 401k plan. So we'll go over those solo 401k eligibility requirements. Let's see here. Looks like we got a question here from an existing client. I'm filling out a transfer form for a census. Under the direct rollover section, is it okay to have them be an Ameriprise mail the check to my home address payable to my trust name? Yes, because you are the trustee of the solo 401k plan. Therefore, as long as that check is made payable in the name of the solo 401k, listing your name as a trustee, then that's going to be considered a non-taxable direct rollover, or in this case, trustee to trustee transfer. So as a trustee, you receive the check in the mail and then you deposit that check directly into the solo 401k holding account. So make sure to not first deposit that check in your personal account or your business account, but rather directly into the solo 401k holding account once you receive that check. Okay, thank you for the great question there. So let me share my screen here. We're going to talk about the solo 401k eligibility requirements as part of the process of isolating non-deductible IRA funds so that you can then do the backdoor Roth IRA conversion. To qualify for a solo 401k, you have to be self-employed with no full-time W-2 employees in your business. A full-time W-2 employee is a non-owner W-2 employee who works 1,000 hours or more in your business. If any of your businesses under your control employs a non-owner common law full-time W-2 employee who works 1,000 hours or more, that will preclude you from being able to open a solo 401k plan. Now, solo 401k plans are also for the spouses of the business owners. So if you own a business and your spouse is also working in the business, he or she can also participate in the plan as long as he or she is also working in the business and reporting self-employment income. Here's an example of a one participant solo 401k plan. So you're going to see it's 3 separate holding accounts, one plan, 3 separate holding accounts. The plan allows for pre-tax solo 401k funds, Roth solo 401k funds, and voluntary after-tax solo 401k funds. Since today's presentation surrounds facilitating the backdoor Roth IRA conversion, the gains of that in that non-deductible IRA, those funds are pre-tax funds. Those would get transferred to the pre-tax solo 401k bucket. So that's how you would isolate those non-deductible IRA funds so that you could do the backdoor Roth conversion. Here's an example of a 2-participant plan. Let's say that your self-employed business is an S corporation. You're an owner in the business. Your spouse also works for the business. Both of you can participate in the plan, hence why you see 6 separate holding accounts, aka bank or brokerage accounts, under this slide, because the plan is sponsored by the S corporation. Both spouses are participants in the plan, so both spouses' funds are required to be segregated under the plan. Okay, the solo 401k process is very straightforward. You can go to our open account page to open the solo 401k plan. That way you can get started, and then we can help you facilitate that whole backdoor Roth conversion isolation, so that way you can transfer the gains from that non-deductible IRA to the solo 401k, and then after that you'll be able to convert the after-tax funds to the Roth IRA. Okay, that does it for today. Thank you for joining. We'll be back again here at 1 p.m. Pacific time. Until then, have a great day.